The event will begin shortly. We are waiting for all our guests to join the event. Thank you. Hello, everyone. My name is Noshin, and I would like to welcome you all to another edition of KiwiTech's Angel Investors Panel. Today, we have a fantastic panel discussion on what are investors specifically looking for to make an investment in a company, followed by 7 high-value growth stage startup presentations. I am joined by my colleague Shubham, and the two of us will serve as the moderator for today's event. Now, let's get started with a brief introduction to KiwiTech. It's my pleasure to introduce KiwiTech, a one-of-a-kind innovation ecosystem that's home to 500 plus portfolio startups and 300 plus mentors, all committed to supporting innovators globally. It all began in 2009 when a team of seasoned entrepreneurs who had previously built and scaled a publishing services company for a 9-digit exit decided to start another company to empower startups with innovations. All in all, we at KiwiTech particularly team up with early to late stage startups to support entrepreneurs with 360-degree support in terms of technology, fundraising, mentorship, networking opportunities, and go-to-market strategy. Now, without further ado, I would like to invite our panel moderator, Amy McCauley, VP, VC, and Corporate Partnerships at KiwiTech, to start with the panel discussion. Over to you, Amy.
Hi, Noshin. Thank you so much for the introduction. Welcome, everybody, this afternoon. I hope everyone's so far enjoying their summer. Today, we are joined by Demoter Reddy, an angel investor and serial entrepreneur, Solomon Assad from Sandy Spring Climate Partners, and William Pod, president of Landmark Angels. Hi, fellas. Hi, guys. So our topic today is what are investors specifically looking for to make an investment in a company? Let's look at questions that possibly founders come up with as to how they could possibly get their company to rise to the top of the list of candidates. Anybody want to jump in and take that one? Okay, thanks, Bill.
Okay, Amy. Yeah, it's a complex field out here because you've got a lot of subtopics here: healthcare, energy, clean tech, consumer, fintech, AI, etc. And the question is, does the investor, you have to do your homework, does the investor invest in those sectors? And if so, how much are they, what percentage of the deals are they doing in that particular sector? So that's the key. So you got to do your homework internally here to see if that's going to be a fit. Secondly, investors, including specifically VCs and angel groups, are inundated with requests to present to fund their deal. And everyone thinks their deal is the very best. What they don't realize is there's competition within their sector among everything that the investor is seeing. So the question is, how do you, as a private investor, do you negate the VC's statistics of writing off 85% of their deals? How do they do it? Because they're $400 or $500 million fund. They're hoping for the unicorn, decacorn to carry the entire fund with all those write-offs. Whereas on the angel side, we have to be very careful because our investors don't have generally, or some of our family offices do, but generally not $400 or $500 million of investment, and they're not as patient. So therefore, we've got to screen those deals very heavily. They go through, in our case, 3 or 4 review processes before we say, yes, it's something that you can present at. Meaning, is the company likely to be there 3 years from now? And specifically, we look at the team and board, management teams, how have they been there, what have they done? The board of directors, because they can add value. The board is very significant And if an early stage company doesn't have one, that's something they should get in on right away and get those gray hairs, white hairs into your particular company, because they've got relationships on the customer side and they have relationships on the exit side from the acquisition side. That's very important. And lastly, how's the company going to scale, right? Because everyone looks at that. We don't want to just see numbers up there in a hockey stick type curve and say that. We want to see how you build your numbers. And specifically there, give us a target of 18, 24 months out. Who have you talked to? Who are you talking to? Who are the targets? At what level within that target are you? Are you at the VP level? You're at a CTO level, a CEO level? Where are you within there? What's the probability of bringing them in as a customer? That's very important. Start with 50 and go on from there. And then we can discount some of that we see, and then how much revenue to expect over that period from that customer. So these are important items in terms of what we look for and what the company should be doing on their end to get our attention.
So Solomon, would you like to add to that? And
Sure. No, I think Bill hit a lot of good notes, if not almost all the notes on that front. We have to understand perhaps from the founder perspective as well, that they're starting from the ground level if they're approaching angel investors when they start for the fundraising round. And they need to understand that they need to be able to communicate effectively beyond just the pitch deck. There needs to be a strong narration around the deck itself, the pathway forward to the next step, because there are continuous fundraising rounds, as Bill just mentioned. So the founder needs to be able to easily communicate what is the process from an angel round to a pre-seed round to seed round to then their first price round, which is hopefully within the first few years of the company's creation and then taking it out to market. So agreeing with everything that Bill said, I just think a little bit of additional narration and being very curated to the investor and the investor's profile that you're talking to. So for example, myself coming from the climate tech background and seeing mostly a sustainability or impact perspective, the type of founders that should be coming to someone like me and on this side of the table will be having that type of narration, that type of impact metrics to report on in the narration of their growth. So just being very aware of who you're talking to on the other side of the table would just be a small note I'd like to add to what Bill mentioned.
Demoter, because you were an entrepreneur and now an angel, can you chime in?
Sure. Yeah. Yes, I think so. Very first thing is, again, as all the key points are mentioned by Bill and Solomon, but I would say approaching the investors wise, it's actually best to approach investors through an introduction. Actually, cold emails, just submitting to the websites, they normally get lost in the noise and very rarely get attention. So it's best to actually approach, if you know somebody who knows the particular investor, a simple email from them actually brings it to the top of their attention. So it's so that's where you start with. Then I think a lot of times, at least as I've been as an entrepreneur, I've done that for more than 20 years, and as an angel investor, first thing I look for is really whether the entrepreneur is solving a big enough problem. Is there a big pain point out there that you are trying to solve? And then quantify the metrics of that market. And what is the value of your solution? So a lot of the companies come to us and say, throw all these big numbers, $100 billion market out there, etc. But when you actually go through ground up calculation, bottom up calculation, based upon what you sell your product for and how much the market value would be, I think an entrepreneur coming to the investor with all the details clearly shows that they understand the market and they know how to get to the market. So I think, and I think having a good team with a proper skill set combinations is also very critical. Don't become a founder team just because you know each other, you're good friends. Make sure they're actually good skill sets that are different from each other. Somebody is a technologist, other one is a business guy, a finance person, something like that. So I think a rounded team and then a good market is really the critical starting points for me.
Yeah, I just like to add one point to what Demoter says very quickly is that back on that point of how they're going to scale, how they're going to get that business, because the assumption is ours is going to be the best product and we're going to get into these markets. Well, it's not that easy. You have to disrupt someone that's already in there, most likely doing something similar. And if they already have their in and made with a major corporation, it's going to be very difficult for a particular company to say ours is better, try us, et cetera. It's going to be a long lead time to be able to get to that point. And the other thing they should do is on the sales side. A lot of them think that it's an easy sales cycle. It's not. They can't do it all themselves. A CEO cannot do it all himself. So you need that key sales hire, that someone that has the contacts in that particular industry that can get in the customer's door, that can get their attention and get what this company is doing before that customer. And that's very important. Sounds easy, very hard to do, and it's very hard to get the right person early.
Yeah, if I may add to that very briefly, especially in current economic standards situations, I think it's very important for founders to be aware of the market trends. And currently right now, from the investor lens, we are seeing that runways are needed to be put out more from what's the typical standard 12 to 18-month runway in anticipation of higher cost of capital. So when you're going to fundraisers, be aware of the current market trends. As Bill is referring to, sales cycles, understand your sales cycles through and through, but you may need to even overestimate or over prepare for what the, again, current economic situation is at the time.
Absolutely. Yeah. So, and one question that I get, because I do speak with the founders a lot, is how much should they be asking for? You know, a lot of people come in and say, oh, I need 5 million, or I need 250. Is that too little? Is this too much? I know everybody's runways are different. Everybody's situations are different, but I know you guys hear all these different numbers. How do you respond?
Yes, yeah. I can take that. So, I think, yeah, so it's, so you want to, because this capital that you are raising currently is the most expensive capital, because you're giving away a large portion of your company at this stage. So ideally you would want to raise as minimum as possible, but you have to raise enough to get to a critical value creation point. That's really what you need to define. What is the next major value creation point for your company? Raise enough money to get there, sparing some time necessary to raise additional round of financing after that. So that could be 500,000 for one company or 5 million for one company, depending upon their business and what they need to do to get to. If you are building a battery company, you need a lot of money to be able to get there. But if it is a SaaS company, probably not as much, depending upon what you're doing. So it's really company specific.
Yeah, you also have to look at the amount, at what the investors, how much they're investing per deal, and how much they're going to invest over time. Because if you're going into a seed investor, it's investing 250 to 500, you're not going to ask them for 5 million unless they have relationships upstream with some of the larger VCs, because it's just not going to happen. And you also have to basically specify what those monies are going to be used for. And back on the valuation side here, don't just say, because I'm only going to give away X% of my company, because that's all I'm going to ask for now. Because when it develops, I can ask for more money and keep that percentage small. I remember specifically the bubble in 2000, and that bubble, we kept telling companies, everybody's going to go public. Goldman's going to take us public. This is going to be public, and yeah, the valuations were astronomical, 75 million, 100 million, without companies, without revenues. And what happened is, obviously the bubble occurred and these companies were bootstrapped. They had no other capital, and capital wasn't available in the private markets. They couldn't access the public markets, and they went out of business. As simple as that. So get a reserve, meaning look ahead, whatever amount of capital you think you need, get an 18 to 24 month reserve to be able to carry you, to be able to make those hires, keep those people, not lay them off because you don't have enough money then, and the revenues haven't come in, enough capital to do that. And sometimes acquisitions are available too. Companies they're cash strapped, but if you've got capital, you can use that capital or combination notes in the capital to be able to acquire some of those companies that may be further along than your company is. So keep those things in mind.
Yeah, agreed with everything that's been mentioned thus far. Speaking of bubbles or changes of trends, the last couple of years, perhaps from a founder perspective, it was recognized that a lot of valuations were just extraordinarily high. So founders went out to raise a lot of money, expecting a lot of investors that come in, which they did at very high valuations. And now they're seeing the change of that direction and are surprised by it. However, if we're looking back at towards historical trends and just what we're going to see moving forward, this is actually more of a normalization of valuations, of size of rounds. So again, agreeing with everything that's being said thus far, for founders to be very considerate about the timing for the runway that they're going to provide themselves, and raising as much or as little money as possible in order to execute upon those strategic action items in order to, again, make it to the next round, continue to grow, expand, and perhaps, again, on Bill's note, explore potential acquisition opportunities. As from specifically a SaaS perspective, a lot of software companies have been coming out left and right. What's being anticipated is a lot of M&A activity, mergers and acquisitions happening down the road, where there will be a consolidation of a lot of the software applications out there in the market. So again, being considerate of how much ownership you want to give up, being considerate of the time frame, the timeline for runway to the next round, and being very strategic with the amount of capital that you can deploy and execute on.
So one more point quickly to add is, if you can get some non-dilutive funding, that will go a long way, whether it's from NIH or from NSF or other places. So I think coming to raise money through investors with that non-dilutive funding actually would provide much more, company would look much stronger.
So that all being said, because of the market and how things are going, and I know angel investors and VCs are kind of slowing down, what type of risks are investors typically considering now when assessing the potential of an investment, and how do you mitigate them?
Yeah, I think they're looking at the exit side, as you just pointed out. What are the public markets doing, right? Because they look at the public markets and they look for acquirers, basically corporate acquirers. So those are the two avenues. Recap, not so much, because the companies really aren't doing that today. So on the public market side, NASDAQ, you look at NASDAQ from where it was, I don't know, 9 months ago, it looks like a gold mine now, right? I mean, everything's going up for the most part, and those companies are doing very well. But the question is, at what point are the companies in your portfolio is ready to go public? And you have to anticipate where that window is going to occur, and what's going to happen once you get there. You have to support it. People don't realize that going public is not the end game. Being acquired after you go public is the end game, because it's a Harvard textbook case. You raise money in the private markets. If you can't raise enough money, you go to the public markets. But the end game for all the investors is not just selling your shares to someone else along the way. It's the big end game of a corporate acquisition, and that's even if you're a public company. And we saw on the private on that market here that 9 months ago, battery company, actually the motor with 100 million in revenues, 100 million annual revenues, with a 50 million market cap. Unbelievable, 50 million market cap. And we looked at that, and what were their options? They couldn't raise capital because the tremendous dilution would occur if they did. So they have to go private. You can go private again if you're closely held, and you can do it that way and get, like we have, family office capital can take out some of those or most of those investors. But that's what you have to anticipate. On the private side, in terms of the VC side, I mean, from the angel side here and not the VC side, you have to anticipate again, who is going to put more capital in your company after you put it in. If you're a family office and have basically tremendous net assets, then you can continue to put it in. Most individual investors can't do that. Where's their protection? What we're doing now with our company, inviting the early stage VCs, those that are investing early, and that's, everyone says they do, but they don't. So get the early stage ones that have the relationships with the big guys, the Andre Horowitz in the world is an example, where they can look at the same companies you're looking at the same time, co-invest in that deal, or if not, basically the parameters are set, milestones will be set, so that when they're met, you know where that capital is going to go. Their capital is likely to be there. Saves time for the companies. They don't have to go out sequentially each time, every 6-9 months, raise capital. They can run the company. From the angel side, great protection here if you've got large amounts of capital coming in.
Yeah, I've also recognized the trend that Bill mentioned, that angel investors and early stage VCs, Amy, as you mentioned, are tightening up their wallets a little bit currently at this moment in time. But the investors that know how to invest and will continue to deploy capital. So it's an interesting time in the market to see that early stage investing is not necessarily being considered what it's mostly known for. However, having worked for a quasi-public-private and early-stage investment entity organizations called TEDCO, it's a state economic development arm leveraging venture capital tools. I would highlight for founders to explore their current city or state economic development arms in the startup or entrepreneurial ecosystem as potential alternatives for this current timeframe that we're in the U.S. economy specifically. But again, angel investors, family offices, early stage VCs, pre-seed, seed stage are continuing to deploy capital just in a much more strategic way. So if on the founder side, if you can learn more about what their strategies are and what they're hoping to invest in and what they're seeing, what metrics they're looking at, what patterns they're seeing, I think you'll have just as much progress as we were having in the, again, 2020, 2022 timeframe.
So for me, I'm involved in angel investing mostly. So as a result, look at mostly the seed and pre-seed stage companies, so companies in very early stage. So for that, what we are seeing primarily, including myself, is we're doing much more due diligence now before making a fund commitment. Before we used to be 2 phone calls and maybe a reference call, and then you make investment. Now it takes 3 to 6 months of several meetings and thoroughly understanding the company, their business model, and their customer pipeline, all of that. So be prepared. The diligence process, even for small angel investment groups, is no longer 1 or 2 phone calls. It actually takes much longer time. And so the best indicator for me is a company which has some amount of revenue. Getting that first revenue from a paying customer says a lot about company's trajectory. And so coming to the investors, having a first paid customer and with a pipeline behind it actually would be the best way to get started.
Well, that's great, because I just got a question from the group, and that kind of leads into this. So there is a startup founder, and he is asking, what do you consider more important, seeing a TAM, SAM, or SOM analysis, or understanding a startup's customer acquisition strategy to help de-risk the investment?
I think Demoter hit on this earlier.
Yeah.
You're right. For me specifically, TAM is the large enough market that you're looking at. Is it even, first off, is it possible for you to become that unicorn company? Does that possibility even exist in this conversation? But for the short term, I'm very personally focused on SOM, the SOM, the obtainable market, because that's who you're directly focused on within the short term, next 2 to 3, 3 to 5 years. And that's who we're going to be focusing on. And hopefully it's a bottoms up approach, as Demoter referred to earlier. The acquisition strategy, that comes into play, but it can't be you can't put all your bets into the acquisition. There has to be a balance of exit opportunities that because these are all projections. And naturally, as an investor, we're discounting any projections that founders bring to the table, because again, economic times, and it's uncertain. So we do have to take all that in consideration. But hopefully that provides a little perspective on TAM and SOM. SAM, it's good to know, but at the early stages of the development of a company, I think those two are more important.
It's just the beachhead market. So I think your market entry, so where you are entering, who are your first few customers, understanding their needs clearly. I think that's definitely critical. So once you get there, then scaling, how to get a larger portion of that market becomes critical.
I think the thing I like to add here is the strategic side on that is very important. So how do you approach, do you have anyone there that knows your business well? And then again, as I said earlier, is helping you target your specific customers, where you're going first. You're going to have multiple targets, but you basically have to have, people want to see, as Demoter said earlier, you want to see revenues. Where are you going to get those revenues first? How are you going to get those revenues? Do you have customers? Where are those customers? How many do you have? And that's by building that target customer list, which I talked about earlier. That's very important because that's the detail here. Because otherwise, as Solomon says, you're gonna basically, VCs, the way they do their analysis, they discount usually 25+% right off because they don't believe any of the numbers. They don't believe the hockey stick. You have to show them. You have to build your model very carefully. And if you don't, they're just going. And some of these things we see are ridiculous. They're going to go from 10 million to 500 million in 3 or 4 or 5 years, which is absurd. Microsoft didn't get to 100 million in 5 years. So how are they going to do it? So build that and build those numbers strategically, very carefully, and use strategic partners. I ran a company myself, a software company in Boston. I used all the strategics, EDS, Sun Microsystems, et cetera, because the company didn't have any revenues. And this way I paid 17%. We had a great product, but 17% to these guys all over. And that's great because ultimately we're dealing in millions of revenues, not a few 100,000. And that builds it. So I took it from 0 to 4.5 million in part-time. And in the 12 months I ran that company because the chairman of the board fired his fourth CEO. I was there by default, having put 10 million in the company. So you've got to be able to do this very carefully and strategically. And last point, only hire the customer, your basic employees as needed, as you're growing from the revenue side, as you see yourself growing. But strategic partners, key to scaling.
That actually answers a question or leads into a question that we got about strategic partnerships and how important that is. So thank you, Bill, for jumping in on that prior. Yeah. Solomon, Demoter, do you have anything to add to the strategic partnership ask?
I think so strategic partnerships are definitely critical, especially in nowadays where getting private funding is more difficult. But entrepreneurs need to be very cautious because strategic partners have multiple reasons they want to partner with you. So you really need to understand your partner very well as to what their interests are and how that plays with your long-term goals. So I think partnering with somebody for getting a short-term benefit but a long-term harm is not a good idea. So I think so you should really understand who you're partnering with and how that will play out over time. Gives enough thought into that.
It's a great point.
Yeah, agreed. Yeah, not too much more to add on that topic besides the fact that corporates are in general, just with the growth of entrepreneurship as its own industry, perhaps, has gotten a lot of attention from those later stage corporate arms that are actually now creating their own investment arms, CVCs, we'll call them, corporate venture capital arms, that are very keen on exploring the entrepreneurship ecosystem. So you can create, if you can recognize a CVC that's relevant to your industry, as well as that corporate's incentives, as Demoter was referring to, as if your incentives and their incentives are aligned, then perhaps that's a way to explore a collaborative opportunity for your growth as a startup company.
Thanks.
Yeah, I can tell you from a personal experience. When I started my first startup, the first check was written by Samsung Electronics based upon an idea on paper. We had nothing to show, but we convinced them, and Samsung Electronics wrote a first check. Then 3 months later, we had 3 VCs funding us to build the company. So that actually provides significant leverage and bring in the capital from other sources. If you can get one of the major players to partner with you.
I do have to caveat that though, if you're too early, and maybe Demoter, you had a really good experience. If you're too early and you have a CVC on your cap table, that can actually turn away some private VCs because they think now you're dedicated and solely aligned with that corporate. So just depending again what your incentives are, what your goals are, being strategic with those type of relationships. But again, great opportunities out there to create those corporate relationships and strategic partnerships.
Thank you, guys. So since we're coming to the end of it, here is a question that gets asked a lot and has come up on the Q&A. So as a founder, if you do not have a network of angels and VCs for warm introductions, how do you create the connections to get the introductions to investors?
It's interesting. That's an interesting question because obviously, how do you start? You have to start someplace, right? And if you don't have the board members, you don't know anybody. One of the companies, kind of interestingly, is the way they did it, which is surprising. They went to their alumni, happened to be Indiana University, and he had no connection with Mark Cuban, as an example. And he just basically went to the alumni group. He saw Mark Cuban was an investor there, and he approached Mark Cuban. Cold call to Mark Cuban saying, this is what we're doing. Love to have you there. And we get, like I went to Notre Dame and University of Virginia. So I get those type of relationships, which they say, oh, you went to here. Can you take a look at this? Yeah, because I feel a connection to the university and the alumni group. So I will go ahead and do that, especially for the younger people, because that's what I remember when I was that young and wished I had done that, et cetera. So I help out in that case. So I think that's one example what you can do with the connections you have. And the second thing is use your friends and family connections. You'd be surprised who they know. Yeah. And if you don't ask them specifically, who do you know? This is what I'm doing. Do you know anybody that is an investor? Do you know anybody in this particular category? And then you can start using those connections, your friends, school friends, et cetera. Just use those connections overall. You'd be surprised what you can get out of those.
I think pitch competitions is another one where you don't really need to know anybody, and then you can enter those. But I think so from that you get exposures to many other investors. One example is Pepperdine University runs the fundable company competition every year. I think if you can enter those and get attention to those competitions, I think you'll get some exposure to investors.
Yeah. On Bill's note with looking back at your own personal network, personally recognize that the undergraduate college that I went to, they had their own angel network I wasn't even aware of until after the fact I was done. So again, leading back into these different, even though perhaps an organization you used to work for, your previous boss, he might have known someone, or he or she might have known someone, family, friends, looking back before you look forward to making new connections, see what's there. But also I think you don't have to perhaps even leave your laptop anymore nowadays. You can go onto LinkedIn and become a thought leader in your industry and start spreading the message and your knowledge of your industry and the solution through that platform and naturally bring attention to you. So there's a lot of solutions out there to gain access to those networks and open up those communications. I believe it's just putting yourself out there and taking that first step forward.
Yeah, one more point on that, Smolers, because it's a good point you just raised. The key to that is, like we have Notre Dame, I've got the Irish Angels, Northwestern has their own group, Harvard Business School alum has their own group. We get indications from Columbia and Yale, they do a joint conference together, et cetera. So yeah, look at those groups within particular colleges because they're growing and they want to promote their own companies made for their own people there. So that's what they do. Yeah.
Yeah, absolutely. I always suggest looking in your backyard and turning to your alumni association. Those are great connections. And I really want to thank all three of you for being part of the panel. I am getting the hands up from Nosheen that it is time to start the rest of the event. And so I thank all three of you. I appreciate it so much for jumping on and being part of this today. And I will now turn this all over to Nosheen.
Perfect. Thank you.
Thanks. Thank you, panelists. On behalf of everyone who joined us today, we sincerely appreciate all of the wonderful insights and perspectives